Welcome to Life, Finance, and Real Estate, where we discuss how to make smart money moves, the ever changing real estate market, and of course, things going on in life. And here to talk about it more with you is your host, Kirby the Realtor.
Straight down, came up. God made a way. Stay down, came up. God made a way. Stay down, came up. God made a way. Let me tell you about it. You can sit and wait around. You can make it happen. I've been walking in the spirit. Ain't no way around it. And it's up. Yeah. And it's up. Yeah. Pedal to the metal, headed to the top. Swerving around the block, this be getting hot. It's so hot. The holy got a purpose, I can't ever stop. I got Lamborghini, mercy on me. I'm outside with the coupe. Look at that, deja vu. Not with the trap, but I'm still on the move. Holy got the Holy Ghost, I'm jumping through the roof. I was down, but I stayed down, came up. God made a way. Stayed down, came up. God made a way. Stayed down, came up. God made a way. Let me tell you about it. You can sit and wait around, or you can make it happen. I've been walking in the spirit. Ain't no way around it. Running in the spirit. And it's up.
Hey family, hey family, hey family. Welcome back to Life, Finance, and Real Estate with your girl, Kirby the Realtor. Yep, that's me. Last week, we had a very powerful conversation about building what Mr. Charles called your financial chassis. And I hope you guys remember what that means, your financial chassis or your financial foundation. Because even when we start talking about investing, a lot of people always want to talk about investing or buying stock and owning real estate. They want to do all that first before even having a foundation. But as Mr. Charles said, we have to make sure the foundation of our financial life is solid. So last week, we're going to recap kind of what Mr. Charles, there was 4 major things that he spoke about that every person should have in place before they even begin investing. First, he talked about understanding your financial chassis or foundation. That means having protection in place to protect what he called the goose and the golden eggs. Do y'all remember that story? Are you the goose or are you the golden eggs? And what's more valuable? Is it the goose or golden eggs? Of course, it's the goose, okay? The goose is you. You are the goose. A lot of people think that their house is their biggest asset. They think that their cars are the biggest asset. Some people even think their children are. That's funny, but I'm for real. They even say their kids, or they think that their retirement accounts are their biggest assets, the savings account. But Mr. Charles reminded us last week that the most valuable asset that we have is you. You are your most valuable asset. The house, the car, and everything else that you have acquired in this life are those eggs. But if something happens to the goose is you. If something happens to that goose, the eggs are at risk. So the first step in building a strong financial foundation is protecting the asset. What is the asset? Who's the asset? YOU. The asset is you. That brings us to the second thing he talked about, which is protection. Protection means making your income and your family, making sure your income and your family are covered if something unexpected happens. Charles talked about disability insurance and how important it is. And if you work a job, you should see if your employer offers disability insurance coverage. Because let me tell you this, back in 2017, 2018, Mr. Charles asked me, did I have disability insurance? I said, absolutely not. I mean, I'm self-employed, so why do I need that? Life insurance. And then I told him, I can't afford it. And do you know what his response was? You can't afford not to. I was like, what do you mean? He was basically saying you can't afford not to have disability insurance. If something happened to you today, where would your family be? So I say to you, if you are self-employed, it's even more important to look into disability insurance for yourself, because the reality is if you go down for 6 to 18 months because of an accident or something unexpected happens, you can lose everything that you worked for. Everything. Your house could be at risk. Your cars could be at risk. Everything that you built can be affected. And all because the goose, which is who? You, cannot produce that income anymore. He also talked about life insurance. Life insurance gives peace of mind because it creates an immediate estate for your family. If something happens to you, that means money can already be set aside for things like paying off the house, helping the kids with college, or supporting your spouse. Mr. Charles also explained that at many age stages of life, especially when you're younger and building term life insurance, can be one of the most practical options. It works as a lot like homeowner insurance and car insurance. So you are protecting what matters most during your working years. So once you have protection in place, now your foundation is starting to take shape. The third thing he talked about is having an emergency fund. Before you start aggressively paying down debt or investing money, you need a financial cushion. Because guess what? Life happens. And I know many of you on here that are listening to me, life has happened. Your car has broken down. Your refrigerator went out. You've even had a house burn down. Medical issues happen. Unexpected expenses show up all the time. So an emergency fund, an opportunity fund, all of those, keep those moments from turning into a financial disaster. Without one, people often turn to credit cards, because I'm guilty. Credit cards, job loss. Oh, I ran those credit cards all the way up. Loans just to survive those moments. And y'all, I'm telling you, y'all know I'm always honest. I have been there. I was just recently there not too long ago. Credit cards and loans just to stay in business, just to pay their house note, just different things. So that emergency fund becomes part of your financial stability. The fourth thing Charles talked about was debt elimination. Debt is one of the biggest things quietly robbing people of their wealth. And do you want to know why? Because compounding interest. Do you know what compounded interest is? When you invest, compounded interest works for you, but when you carry debt, guess what compounded interest does? It works against you. The longer that debt sits there collecting interest, the more of your money it takes away from your future. So creating a plan to eliminate debt becomes one of the most powerful steps towards wealth building. And once you have protection, once you have an emergency fund, once you have a plan to eliminate debt, then you can start looking at investing. So during the conversation, Mr. Charles also talked about some companies that people are watching from an educational perspective. Companies like Costco and Walmart, even defense-related companies because of what is happening globally. But he made it very clear that there were educational examples, not specific recommendations, because every person's financial situation is different. So the real message from last week's episode was this: building wealth does not start with stock tips. It starts with structure. And when you build your financial foundation the right way, you put yourself in a position where money can truly grow. So today, we're going to have another conversation with Mr. Charles Thomas, because he wants to do just like me, help you own your life, own your finances, and help you build real assets through ownership instead of borrowing. So it's another great day on life, finance, and real estate, and we're going to welcome Mr. Charles Thomas back. So, Mr. Charles, are you there?
I'm here, Mr. Terrell. Great job. Says sit there listening to you. If you ever want another occupation, I'm always hiring people across the country. So let me know. You did a wonderful job on that.
Well, thank you, sir.
So what's your first question for me today?
Well, my first question, because oftentimes we have people reach out about, wanting to invest, but they really don't know what it means. They just hear people say they're investing in what stocks, and I know that you're pretty good at that. So I guess my question would be, what would you say to someone that wanted to start investing?
Great question. I get that all the time. People have a fear of investing because they don't understand investing and what that looks like. But first of all, let me just do a little, not really a recap, but if that financial foundation is in place, what you just talked about, and they got a debt plan, they can actually pay down debt and invest simultaneously if they want to, if they got enough margin, margin. So as they do that with a skin sheet and find their discretionary income, which is their cash flow, They got to think about long-term goals. Investing is different from saving. Saving is when you're saving for a particular event, a wedding, to buy a car, a down payment on a house, those kind of things. Investing is a long-term perspective because markets tend to go up and markets tend to go down. I want to make sure we're clear on that on the front end. So the very first thing you need to understand about investing, why do I need to invest? The reason you need to invest, you need to understand the power of the dollar, whether it's going to go up in value or go down in value. And that's determined by something called inflation. I'm in the classroom sometimes talking to people. And I say, somebody tell me what inflation means. I've got 20 people in the class, and maybe one or two people out of the entire class tells me what inflation means. So can I engage you just a little bit, Ms. Harrell?
Sure.
When you think of inflation, what do you think of?
I think of increased in like cost.
Okay. You've been in the Army for a while now, so you know what inflation means. So yes, inflation is the increase of cost of goods and services that we use every day. Now, why is that important? Because inflation has a certain percentage that has been averaging for about the last 20 years. That's around 3%. Now, I want to make this really simple so people understand this. If I had $1,000, I had $1,000 sitting inside of a CD, and that CD paid me 5% a year. 5%. I'm keeping it real simple. That means that CD paid me that 1 year, it paid me $50. Is that right?
Yes.
All right. Now, if inflation is 3%, that means the cost of goods and services went up by 3%. What's my real return on that CD?
2%.
2%. That's really important to understand this. Now, secondly, that CD was not protected from taxes, right?
Right.
That means when you take that CD and you redeem it, and you got that $50 that you're going to add to your income, the first thing happened, inflation took 3% of the buying power away almost immediately. The second thing happened, that $50, if you're in a 20% tax bracket, that's 20% of that $50, which is another what? $10, right?
Mm-hmm.
So you netted out only about 1% on that CD, which is about, I don't know, actually $10 after inflation and taxes. So are CDs good investments? Because people want to ask, are CDs good investments? Depends on where you are in life. It depends on if you are risk adverse. You cannot stand risk. You cannot stand markets going up and down. CDs may be an okay place to put money. Just understand you're almost investing at a loss because your net return is not going to outpace inflation on a daily basis. And with your taxes, you're still at a deficit. So you make that decision yourself if 1 or 2% is a good return for you each day on a CD. So that's the first thing to understand is inflation and taxes. So is your investment tax deferred or tax free? There are a lot of investments out there, especially if you work in a job, you don't have a pension, you don't have a retirement plan. There's something called IRAs. There's a Roth IRA, that's a traditional IRA. The Roth IRA, you take money after you get paid, which is your net income, and you start that particular investment inside of a Roth IRA. Let me stop just 1 second, because I get kind of caught up on this myself sometimes because I have to let people know a Roth IRA, a traditional IRA, a 401k, a TSP, a 403b, those things really are not the actual investment. They are tax codes used to start an investment that's tax advantage, okay? Tax advantage. So let's talk about the Roth IRA real quickly here, but we don't have a lot of time. A Roth IRA, when you get paid, the net money you bring home, you take that money and start your Roth IRA. That means that money is going to grow tax-free. It's going to grow tax-deferred. You're going to take it out tax-free. That's beautiful. Everybody on the planet should have a Roth IRA because I'm telling you right now, if you think taxes are not going to go up, then you're fooling yourself. For the federal government to support itself in all the entitlement programs that we have, I'm talking about from Social Security to the Affordable Care Act to Medicare and all that stuff, defense spending, the only way the federal government can raise money is through taxation. So I encourage everybody on this call to definitely try to get you a Roth IRA. You can start a Roth IRA. Roth IRA is $50 a month. So don't use that you don't have the money to start one. You can start with as little as $50 a month. When with the compounding and earning a good return on your money, you could be okay the next 15, 20 years. The second type of RA is called a traditional RA. That works kind of like a 401k. Let's say you're making $50,000 a year. And let's say that the maximum amount you can put inside of a traditional RA, let's say it's $7,000. I think it's $7,550, but let's just say $7,000. That means if you took $7,000 and put into a traditional RA, at the end of the year, you made $50,000. You can take that $7,000 off the top of your income like you never made it. Okay. Now that money grows inside of that particular investment, whatever you have inside that traditional RA. That money grows. It grows tax deferred. It grows tax free. But when you take it out, you got to pay taxes on it, like ordinary income tax. So understand, the Roth IRA, you take money out tax free. The traditional RA, you take money out, you got to pay taxes on it. Same thing happens with a 401k and a 403b. So that's how those things work. 401k comes out before you taxed on it. You're not taxed on it. It's pre-tax, okay? A 403b is pre-tax. That pre-tax means the money come off the top of your income before you get it and go inside the investment. Now, the reason I'm telling you about these things first, because a lot of you guys out there have companies that are 401ks, they're 403bs, they're TSPs. Make sure you participate so you can get the free match. That's free money before the money's already been invested. So make sure you invest in those programs on your job. Now, I talked about that, Ms. Harrell, on the front end. It's not very difficult. You can go online and Google this stuff and get the definitions for it if you want more understanding of it, because we just have such a little time here. So let's go into investing now. Let's go into investing. When you invest, your investment needs to outpace inflation. And the reason it needs to outpace inflation, because inflation every year devalues how much your money can buy the next year. If your investment is only earning 3, 4, 5%, guess what? That money's not going to ever grow. So the first rule to investing, you got to get 3% or more on your particular investment. So where do you find those kind of investments? Well, I think people ought to put money in the mutual funds. They ought to put them in the stocks. They ought to put them into ETFs. ETFs, like exchange traded funds, they're very similar to mutual funds. But let's talk about the risk factor that people have with these type of investments. Let's talk about a mutual fund. There's a mutual fund out there with Fidelity. I'm going to tell you what it is. I'm going to let your listeners go out there and even look it up and go to Fidelity and get it if they want to. I don't care. It's just information they need to know. There's a fund at Fidelity called the Semiconductors Fund. The code is FS, I think, LEX. It's called the Fidelity Semiconductors Fund. A mutual fund is where people pool their money with other investors all across the world, and they turn their money over to a money manager. That money manager gets up every morning with a cup of coffee in his hand, and he's managing that money. Typically, you could not hire one of these money managers unless you had maybe $3, $4, $5 million. But because we all pool our money inside of a mutual fund, now we're sharing the cost of paying that money manager. And most of those money managers charge anywhere from 0.5% to 1.5% a year to manage those funds. So I don't get caught up in the fees. When I look at investments, I get caught up into the returns, the results. That Fidelity Semiconductors Fund over the last 10 years has averaged 30%. It came out in 1985. The fund is 41 years old, managed by Fidelity. Over the last 41 years, that fund has averaged right at 15% a year. So what does that mean? Did it make 15% every year? No, it did. Not every year. Excuse me. The fund went up and down over that period of time. But as it went up and down over that period of time, it averaged out those kind of returns. That's what you're looking for. That's why I call it a long-term investment. So think about that just for 1 second. If you'd have been putting $100 a month into an investment that's earning 30% for the last 10 years, how much money would you have now? Mr. Earl, can you go to your phone or go to bankrate.com? Bankrate Simple Savings Calculator. If your audience is listening, go to Bankrate Simple Savings Calculator. Okay? Mr. Harrell, are you there yet?
Yes.
Okay, I want you to put $100 in there, and I want you to put $100 per month, and I want you to put, we always use 20-year periods, put 20 years in there, because that's that lost opportunity cost I talk about all the time, that $100 over a 20-year period. And I want you to put the actual returns, well, let's do 10 years. The actual returns, what Fidelity has returned over the last 10 years, which is 30%. So put that in there for 10 years at 30%. How much money do you have?
Well, okay, so let me confirm something, because my calculator has initial deposit, monthly contribution, and then over a period in the APY.
That's correct. APY is the interest rate you can earn. That's correct.
Okay, so for the initial deposit, what am I placing in that box?
$100.
$100. Monthly contribution.
$100.
Okay. And then 10-year period.
Yes.
And what was the rate again?
The rate with that particular fund is 30%.
30%. All right. Interest earned says $47,121.
And how much money was put in?
You only put $12,000 in.
And it grew to how much?
To $47,000.
Can you imagine that? Now go back and change the time. Go back and change the time to 20 years and change the interest rate to 15%, kind of what is averaged, okay?
Okay. So we put $24,000 and we earned $108,000.
I want you guys to understand that. $100 for 20 years at 15% interest returned $108,000 because we're able to get a higher interest rate on our money. See, that's the fear. Well, not the fear. That's the expense of not knowing. See, a lot of you guys on this call right now, you didn't know you could get 10 or 15%. You didn't know you could get 30% for the last 10 years. And what you don't know can hurt you financially. So that's why I like this call, Ms. Harrell. You're giving people financial knowledge they can use right now. Now, watch this. We talked about that one mutual. I'm not going to talk about any one mutual fund. That's one mutual fund. Let's talk about some stocks real quick. You go in the stores every day. Let's take Costco, for instance. Ms. Harrell, can you help me out here a little bit, okay?
Okay.
Take Google and go to Google and Google Costco stock YTD. YTD means year to date, okay?
Okay.
When you get there, I want you to take a look at the year-to-date people that are listening. Year-to-date means from January to now. Click on year-to-date and look inside the parentheses and tell me what is Costco's return so far this year.
Okay, so I do Costco stock year to date. Okay. 17.82%.
All right, now think about that. What we're talking about. I talked to you earlier about that CD earning 3 or 4% a year, and they're not 1%. Okay, for a whole year. That same money put into with Costco stock will return 17% already this year. Let's take the last 5 years. Take a look at Costco and see what their returns were the last 5 years.
217.26.
So if I took 217.26 and divided that by 5, it would tell me the average return that Costco has returned on your money for the last 5 years if you own Costco. Were you able to get that number?
How many years did you say?
The last 5 years.
Okay.
217 divided by 5. What is that?
Ooh, that's it. 4 something. Hold on. 217 divided by 5. 43.4.
So that tells me over the last 5 years, Costco has returned to their investors on an average of 43.4% a year. That's what I call a hidden in plain sight. Costco is a blue chip stock, hidden in plain sight. You go to them every day, and if you don't own it, you miss that 43% a year. Let's look at Walmart. Do Walmart the same way. Walmart.
Okay.
Walmart stock YTD. Walmart stock YTD.
13.35%.
So as of January, Walmart has already returned 13%. Is that amazing?
Yeah.
Let's look at their 5-year return
196%.
and divide that by 5. 196. Just say 197 divided by 5.
39.
So Walmart has averaged over 39% for the last 5 years. Another jewel hidden in plain sight. So ladies and gentlemen, I'm just going to share those two stocks with you because I want you to know right now the companies that you're doing business with every day, building their fortunes, you could be a part owner in that company because when you buy a stock, that makes you part owner inside that company. You got it? So Charles, how do I get these stocks? Go to Charles Schwab, open up a free account. Go to Charles Schwab, put, I don't know, whatever you're going to buy, $500, $1,000, whatever you're going to put inside the account and buy you some Walmart and some Costco stock if you want a good blue chip company that's going to be around for a long time. You know, I can't make recommendations to you, ladies and gentlemen, because I don't know your situation, because this is, as a disclaimer, this is the education conversation with Ms. Harrell on her show. But I just wanted to show you, don't be afraid to invest in long-term blue chip companies. You cannot afford not to be an investor. You cannot afford to put money inside of a bank account that's earning 1 or 2% a year and inflation eating up all the profits. You got to learn how to become an investor and be okay with that. It's okay to invest. It's okay when the markets go down. It just kind of depends on where you are in your life. Okay? You know, if you retired, it's okay to take 5 or 10% of your retirement money if you got a lump sum of money and put them to the market. It's okay. It's going to go up and down. I'm not saying put all your money there, but if you want to leverage some of your returns and your retirement dollars, that 5 or 6, 7% you get on your retirement dollars, it's okay to diversify a bit and put a lot of that money, not a lot of it, but some of that money into some stocks that you can trust. Mr. Real, I don't want to do a disservice to your clients, to the people that's listening, but this investment stuff can make you literally rich with a good person that's holding your hand through the process. Don't be afraid to learn about basic fundamental investing. You're doing a good job with you teaching people. Own your life. Don't rent your life. You rent your life if something happens in your life and you lose everything. That means you don't own it. That's why you got to have the emergency funds, the disability, the life, all that stuff is put you in a position to own your life and not rent your life. Okay? So become an owner, not a loaner. Keep listening to life, finance, and real estate so you can own a piece of America. Own your life. Back to you, Mr. Rell.
You took my saying, huh? Yeah, owning your life, your piece of America, rather. But guys, listen, this is the kind of stuff I get all the time, 1-on-1 with the one and only Mr. Charles, and because of him, I know what my future can look like. Because not only does he educate, he challenges me quite frequently, and it's not easy when he's putting me through, but I know it's for the betterment. And Mr. Charles, I want you to know I appreciate you publicly. I do appreciate you taking out time to even, impart all the good stuff to my audience here, because you've made me a better person financially. And I think and I know that just by them hearing what you've given today has blessed them as well. So I appreciate you taking out time.
I'm honored to be on your call.
But y'all, this season in my life, I am just so excited about this season, and this the kind of stuff that I get all the time. So just to share it with y'all makes me feel good. And this is how you own your life. And I stole it from Mr. Charles, so that's why that was a little joke I said earlier. But owning your life and owning a piece of America, this is how you build real assets. This is how you own your life. This is how you own your finances. I appreciate you all tuning in today and listening in, and I hope that you have been blessed on today. I hope you have a great day. Bye for now. See you soon.
Thank you for tuning in to Life, Finance, and Real Estate with Kirby the Realtor. You can catch us every Thursday at 12 p.m. on 92.1 WJMG, 93.1 WGDQ, and also you can listen live at 921WJMG.com or 931WGDQ.com. If you happen to miss the live recording, don't fret, we'll replay it at 6 p.m. tonight. Thank you once again for listening to Life, Finance, and Real Estate.
Straight down, came up. God made a way. Straight down, came up. God made a way. Straight down, came up. God made a way. Let me tell you about it. You can sit and wait around. You can make it happen. I've been walking in the spirit. Ain't no way around it. And it's up. Yeah. And it's up. Yeah. Pedal to the metal, headed to the top. Swerving around the block, this be getting hot. It's so hot. The holy got a purpose, I can't ever stop. I got Lamborghini mercy on me. I'm outside with the crew. Look at that deja vu. Not with the trap, but I'm still on the move.